welcome to this episode of Bits by Bacon. I have the pleasure of introducing our guest today, who is Cory Thompson with Legend Home Lending. He has nearly 30 years experience in the mortgage industry and loves to train mortgage lenders, originators, those coming into the industry. And he also has an angelic voice. So maybe you'll have the privilege to hear him later, but Cory, thank you so much for joining me today. I'm so glad you're here.
Thank you for the opportunity, Misty. Being with you is always a lift. And lighting here, you said angelic, it looks like I have a bit of a halo today. So
You do.
I'm sorry for the lighting for your viewers.
You carry it with you. I love it. So tell us how you got into lending and how have you stayed in it for as long as you have?
Okay. I'll try to be brief here. I don't want to give you all of my background, but in short, I went to Baylor, graduated with a finance degree, minor in accounting. I didn't want to use the placement office there and go to work for one of the big 8 accounting firms at the time. So came back home, Pasadena, down Dina is where I'm from. Won't hold that against me.
I won't.
So I worked for my dad for short of a year. And I spent those months talking to people, seeking counsel from trusted advisors and family friends and other people that I've met along the way, and really tried to explore a lot of industries. So I interviewed a lot.
Okay.
At the end of all of that research and discovery, I had a friend who's in the mortgage business. We played softball together, went to church together. His brother was coming back from California to open the Houston market. Now, I was 23 at the time. You need someone to give you a chance in this business. So he did. And I've had great manager, great mentors along the way. So my brief story is graduated from college and then found a way to use a lot of the relationships that I had to get in the business. And it has been a 30-plus year career for me.
That's awesome. That's awesome. You're amazing at it. We actually are in a deal together right now. We close on Friday. I'm super excited about that.
I am too. Yes, I'm glad.
So let's tell the listeners that may not know, what does FICO stand for? What does it mean? What does that look like?
That's a great question. In our industry, everything starts with credit score. All of it. Really doesn't matter what your income may be or what the assets are, your funds to close. We focus on 3 different aspects early on with your buyer, with the borrower, and that is credit, income, and asset. So to your point and to your question, the credit is extremely important. And FICO, FICO, those letters stand for Fair Isaac Corporation, the company, and has become the industry standard for measuring credit risk through a score. So I think it was in the 50s, mid-50s, FICO was established and came up with algorithm, if you will, a model, scoring model, to produce a numerical representation of credit risk. So that's who FICO is. FICO, FICO, Fair Isaac Corporation. And they are, especially for the lending industry and specifically the mortgage lending industry, they are the standard. They produce a numerical score. Those scores can range from 350, 400, all the way to north of 800. If you have an 800 score, that's obviously top level. I can't get into all the aspects of it. We'd spend a whole day on it, Misty.
Right.
We're not going to do that.
Sure.
But that's who FICO is, and that's what they are producing, which is a numerical representation of credit worthiness.
And that is based on some criteria.
Correct.
I don't remember all of them. I know I should know this, but it is length of credit. So if you have a credit card, how long you've had it. It's the, not debt to income ratio, but the balance. It's the balance versus your availability. I'm not saying that correctly. And it's the paying on time. And then it's inquiry, something about having a mix of new and old. Did I get that anywhere near correct?
Why do you need me on this call, Miss?
I think I was going to remember it all.
If you were to look at the pie chart, you summed it up pretty well. I believe 35% of the score would be considered pay history, so timeliness. How well do you pay your bills on time?
Right.
Credit conduct, as we can call it. So that's 35%. 30% is credit utilization. You summed it up pretty well, and that's balance to limit. So the balance on your card, credit card, and then the limit, which is speaking specifically to a revolving type credit card account. Your installment, you start with a certain balance and then pay that down. So there's still high credit there in your current balance, but really for the revolving debt, that utilization plays a huge part in the credit score.
And there's a magic number of what you want that to be under.
That's a great aside. We can step into that one, or step outside of that one category and say this, that the model, the algorithm is going to rank or rate the consumer based on utilization. So if you're 30% usage or 33% usage or less, that is going to be better than if you're at 50% usage. So a $5,000 limit credit card with $2,500 balance, that'd be 50% usage. Go up to 75%, you get north of 75, you get to 90, you get to 100%. That's maxed out. Obviously, the model, the algorithm, it can say, oh, hold a second, this is risky. So that will be weight on your credit score. So credit utilization. Now, you also mentioned length of credit. So depth of credit, as we may call it, months reviewed, the history of your account, how many accounts and for how long have you had them? That's 15% of the score. And then the other 20% is broken out into 10% credit mix, installment, and revolving mix, and revolving being the open-ended account, installment being the closed-ended account. So that's 10%. And then the new credit and the inquiries is 10%. So if a consumer is making inquiries every week or every month, the system says, algorithm says, ooh, what's happening here? This borrower, this buyer, this consumer is trying to reach for more credit. We may see that as risky.
Sure. And someone that has a lower FICO score, I will say this. So a lender, you plug in people's information and it gives you an idea of what they're approved for. We'll talk about that in a minute. But someone say that they have a high debt to income ratio or they have a lower credit score. What is something they could do to get their credit to increase the fastest? And is there one or two things that they can do?
State the obvious. Pay bills on time.
Pay on time.
Pay on time. Timely payments.
Pay on time.
So that aside, pay your bills. If you don't pay your bills on time, your scores will never be high. Okay?
Right.
So I'll give you 3 How
Okay.
about 3 fast track, if you will,
Okay.
pathway to some higher scores?
Okay.
Number 1, keep your utilization down as low as you can. So your credit card, if you have 75% usage or higher, try to get that down, pay it down, knuckle down on it and commit
Right.
to it to pay that to where your balance to limit is lower, 30% in that range. Okay. So I would say number 1 would be utilization low. A lot of times when we run the credit report, we have a mechanism inside of our credit reporting company that we use, and we use 2 of them, Zactus and Advantage Credit. There is a wayfinder feature where it will tell us a lot of times, if you pay down to, then the score may improve a certain amount. Okay. So pay your debt down.
Okay.
Number 2, collections. Usually the lower score consumer will have some collections. And I'm talking lower scores down in the, say, low 600s, if you will. Okay, 600 to 640 in that range. Below 600, you have several collections. So what I would say there is a pathway to improve score would be, let's identify some collections, target on the lower end, and see if we can pay those and have the collection company agree to a deletion letter. So depending how...
Now, with that said, are they, and I actually did that. I went through a divorce, tanked my credit. I did have some charge-offs, then I did that. I called and I was like, hey, I could pay this. And then at the end, some of them did and some of them didn't. But they wrote it as paid as agreed to borrow or whatever. I don't remember exactly the verbiage, but some of them did help my credit and then some of them did not. But at least in my conscience, I paid my debt.
And that's a good thing. You settle on it. If you have a collection currently and it's there on the credit, and if you pay it, that's not going to be an immediate improvement in score. Over time, it will be.
Right.
So the question was centered around, what can we do to potentially fast track and have a more immediate improvement in score? If there is a collection or some collections, let's see if you can bargain with the collection company and pay X. And usually you're going to settle on that collection with cents on the dollar. If it's a $500 collection, let's say $250 you could settle. Let's see if you can bargain there, pay them more, and then have the collection company produce a deletion letter. And if you have that, we submit that to the bureaus. We can be involved in that a bit. And then that way it's as if it didn't happen.
And it's funny, I just found a manila folder in the back of my little filing cabinet with all my tax returns and things. And I still have some of those letters that said I was paid off. Those were almost 20 years ago at that point. But it's just funny that I found those letters. I'm like, oh, I could probably get rid of these now.
You probably can, but that makes you feel good because you did what you should do and what you felt led to do, and that's to clear these out. So the item, piggyback on someone else's good credit, a relative, authorized user. Perhaps there's a good paying credit card they have with low balance that has long-standing history, depth of credit, low balance, higher limit, no slow pays. Can you piggyback on it to then have a more immediate impact on the score? So I would say those 3 categories could help with improving the score more immediately. We're happy to run a credit and do that analysis and give recommendation. what to do.
Perfect.
Credit
That's
counsel.
awesome.
Now, before we go off of this category, really important for your listener, viewer. Hopefully they're listening and viewing at the same time. Credit Karma is the consumer choice these days for a free credit score. Uses a model by the name of Vantage 3.0.
Okay.
Vantage 3.0 is not FICO. It's not FICO. The lending industry, mortgage lending industry uses FICO version 2, 4, and 5. TransUnion, I think, is version 4. Experian is version 2. Equifax is version 5. That's critical for your listener to understand and the consumer to understand, because this is a weekly phone conversation that we have with potential borrowers. Why is my score different? My score is X.
On my bank, it's this, and on my credit card, it's this. They all try to show their credit score now.
Correct. And sometimes we have the consumer say, I pulled it direct from the bureau. The bureaus, Experian, TransUnion, and Equifax, the 3 bureaus, the creditors report to those repositories, as we call them. They deposit. The bureaus house all of this credit data from the creditors. Before Isaac then comes in and they use their algorithm and their model, and they produce a score. The mortgage lending industry, then we attach to a credit reporting company that then compiles that information, puts it in readable form. But we have that conversation every week. Why is it different? When I pulled it direct from the bureau, and it's different. The bureau may produce a score that might be FICO, but it might be FICO version 8 or version 9 or 10. That's usually what happens. And then we pull it, and the lending industry is required to use 2, 4, and 5 versions, 2, 4, and 5 of FICO with those 3 different bureaus. And then it's different. Okay. That's important. That's critical that they understand. Okay. Along with that, the consumer can go to myfico.com, myfico.com, and for $29.95, they can enter into a trial membership with myfico.com, and for 30 days, get what they need, get what we need to see what their FICO version 2, 4, and 5 are. And Misty, the reason that we do that is, and so we're starting to do that more over the last couple of years, the credit report cost for us these days is $145 for a tri-merged in-file credit report to get TransUnion, Equifax, and Experian. It's astronomical. We used to be able to pull a credit report for $40, $60 just 3 or 4 years ago. It's just skyrocketed. So we try to be good stewards of the money. There's no mechanism for us to charge the consumer $145. So we try to do the right thing when we work with the consumer to give them good counsel, give them pre-approval and all of that. So that's important. I wanted to tag that FICO category with those 2 things. Vantage 3.0 through Credit Karma is not FICO, the different model. The consumer can get their FICO version 2, 4, and 5 through that platform.
Got it. Perfect.
That was long-winded. Sorry.
No, that's perfect. So my next question is about buying power. So a lot of times people will ask me, or you, when you get the phone calls, so what am I approved for? What's the max sales price I'm approved for? And that's not really how you attack it. And that, from my perspective, I just need to know what the max that they are approved for so that I can do what I need to do. But from your perspective, how do you talk to when a buyer calls and is like, hey, what is my max approval? How do you approach that conversation?
I love that lead in with how do you attack it? I love that. It all starts with credit. We're going to have pleasantries. We're going to gather information either on the phone or direct them to our online platform to give us that data. And we want to pull a credit report immediately because we want to know what are the obligations. Also want to analyze income. What is income? Credit and income, and then funds to close. Those are your three categories. But in order to determine what payment they qualify for, we must know the income and we must know the debt. So we'll evaluate that and we'll come up with a payment that they're qualified for. We call it PITI, Principal, Interest, Taxes, Insurance. Also, you got to throw in HOA in there. Sometimes your HOA is nominal, 300 a year, 600 a year. Some of these subdivisions, it could be 1,200 a year.
Right.
So we're going to evaluate credit and income to produce a payment. Then we have to back out taxes and insurance. And that's a little bit of a moving target, Misty, because different areas have varying
2.4,
rates.
Tax rate.
Okay. So that can vary. And then insurance is a key component these days. What? 5 years ago, 4 years ago, the rates started to ratchet up. They've stabilized somewhat. To know those, and then we're going to derive what's a principal and interest payment and then back into a loan amount, depending on how much they can put down. If it's 3% or 5%, they can put down 20%. So we have to back into giving the consumer what are they going to be approved for sale price, and in turn the referral source, the agent, as they look for homes and put them on a certain range. We're going to back into it.
Well, that's perfect. And then you talked about down payment. I am surprised at how many people, and a lot of them are renter, that I get the first thing is, I don't think I can afford to buy because I don't have 20% down. And I'm like, wow, that we need to educate the public better than we are, obviously, because there are different conventional FHA, VA. We talked about that offline. And you mentioned it earlier. So FHA is 3.5% down.
Correct.
Conventional, you can put 3%, 5%, 10%, whatever you want, basically. And then VA and USDA are zero down. Zero, yeah. So my next piece would be, there are some buyers that don't have a lot of extra money to put down. There are some down payment assistance programs. Can you tell our audience a little bit about, in Texas, some of those programs?
Sure, I'm happy to. And let me dovetail on your comment real quickly about the 20% down. That is a misconception still in the marketplace. We wouldn't make many loans if it had to be 20% down, Misty. So that still remains to be a misconception, but you summed it up real well and gave us the categories. If it's a minimum down payment conventional loan, it's 3% or 5%, and then FHA 3.5%. So you summed that up well. There are down payment assistance programs out there. And weekly, we spend time with buyers, potential borrowers, talking through all of that. And it can be a bit of a maze to understand that fully. Two of the more popular down payment assistance programs in and around our area are STET, Southeast Texas Housing, and then TSAP, which is Texas State Affordable Housing Corporation. You can work a conventional loan or an FHA loan with either one of those.
Okay.
And the way that the down payment assistance is provided through the increase in interest rate. So the traditional down payment assistance program is not for free. Some consumers think that.
Right.
There would be an upcharge in the interest rate in order to then create down payment assistance that the buyer borrower can then use for the down payment. And in order to close with little to no money, then the agent, you, are working on trying to negotiate seller contribution as well.
Right.
Okay. So,
Right.
in a general sense, there are down payment assistance programs out there. They do carry with them some bit of a cost, and that is increased interest rate to gain the money. And then also, both of those will have some restrictions with regard to being a first-time home buyer requirement or income limit requirement. Okay. So before I go into another down payment assistance program, comments or questions on that? Did I sum it up pretty well?
I think you summed it up perfectly. And one, you may or may not mention this, but I did not realize this until one of my clients was trying to sell their property. If you do participate in a down payment program, you are obligated to stay in the home a certain amount of time, or you pay back a portion of that depending on whatever that requirement is.
Correct. There's recapture is what that's called. Sometimes there's attached to the program the requirement for that buyer, that owner, to stay in the property. And really, as an overarching comment, the down payment assistance programs are there for the low to moderate income profile buyer. They're not there for somebody that making six figures plus. Maybe on some of them, maybe you could get there depending on the size of household. You get north of $100,000 that you can make and still have some down payment assistance, but they're there for that low to moderate income borrower that has the need. This government money that's being provided on that and backing by certain investors and lenders that participate in that. So that's for sure a full day talking about those programs.
Each one of our questions could have been a whole separate episode.
They can be. Now, I want to tag this category, though, down payment assistance, with this comment. There may be some down payment assistance programs that allow you to borrow the down payment. Okay? Not like the other two, Seth and TSAC, that I mentioned, where you're borrowing in the rate increase, but there could be a standalone second lien, a loan that's given in order to provide the down payment. For example, Legend Lending has its own down payment assistance program that is this. It's an FHA loan, 3.5% down, 640 credit score. So it's not for the 500 credit score or low 600. 640 credit score, FHA, 3.5% down. We will loan the borrower in a second lien, a second loan, 4% of the sale price.
Got it.
So if it's a $250,000 first-time home buyer purchase, 4% of that is $10,000, $10,000 in a second loan, amortized over 20 years, fixed rate, at a higher rate, but only that 10,000 smaller loan is at the higher rate. The first loan would be at the lower market rate.
Got it.
Okay. Not going to go into any other particulars on that other than the fact that no doubt there's no first-time homebuyer requirement.
Got it.
And there's no income limit. So we work a lot of those loans for borrowers that don't qualify for the other down payment assistance because they blow through income limit or they're not a first-time home buyer. So I'm happy to talk with anyone about that and consult on that program.
Perfect. I love that. My final two questions, which I ask every guest, and I answered myself in the first episode, is what advice would you give to your 22-year-old?
I have a 20-year-old son, Misty. I know that's hard to believe, is with the gray hair that I have. I have a 34-year-old stepson as well. But so what I would say to myself, and what I say to my own blood, my son, is go for it. Risk it all. Yeah. Don't let any fear that may well up inside to be a barrier for you to succeed in life.
Right.
And I'm not necessarily talking about just making $1 and making money or a lot of money.
Sure.
I'm just talking about just succeeding in life and having a fulfilling existence where you can accomplish whatever it may be in your relationships, outside of your work, other endeavors, whatever that may be. We like to embrace 2 Timothy 1:7, which says, God has not given me a spirit of fear, of timidity. Don't be timid. But he's given me one of power, love, and a sound mind. So I'm going to take what he's given me, and I'm going to allow him to influence that, and then I'm going to have a no fear type mentality. Awesome. That's what I try to foster in my own son, who is 20.
Right.
But that's what I would tell myself at 22.
That's awesome. And then last, what would you like to be remembered for?
I would like for people to say, Cory Thompson lived with a grateful attitude of heart and had spiritual perspective. The joy of the Lord was his strength. Of that, when I was with him or around him, it was lift for me. That's what I would hope that my family and my friends and people that I come in contact with in my profession to say about.
I can tell you that you are already doing that. I get to see you once a month at a realtor breakfast that we both attend. And every time I see you, you always say, how's Misty day? Or what's going on with you, Misty? And then you give me a hug. And I would like to be remembered for giving good hugs, but I feel like more people are first to give the hug. So anyway, you are living it out, and I appreciate that. And you should also be remembered for your angelic voice. Not everybody can sing, and I love to sing. I can harmonize with people, but you have an angelic voice, and it is something to be grateful for because not everybody can sing, and it is truly beautiful.
I appreciate that. It gets harder and harder the older that I've come, but I sure want to be lift for people. I want to say, and not only say, but be grateful. And that's what I came up with many years ago when somebody asked me, how are you today? Or how are you doing? Instead of just saying, oh, I'm good, I'm great. Right. I just started saying, I'm grateful. And sometimes on those days when I may not be feeling that, when it comes out of my mouth, it helps me remember that I should be. Yeah.
Yes. And there's power in the tongue. So that's scriptural.
For sure.
Cory, I appreciate you coming. We are at the end of our episode, but I just want to say thank you for joining me. Thank you for encouraging us and giving us some insight to our FICO score, what that looks like. And I hope that our listeners are able to grab a good nugget from that, because I know that I was. And so I appreciate you. And I just want to say, everyone, stay tuned for our next episode. And remember, everybody loves bacon. Thanks for hanging out with me on Bits by Bacon. Be sure to follow, leave a review, and send this to that friend who always wants the inside scoop in and around the Houston area. I'll see you next time with more stories, real estate talk, and a little bit of everything in between. And remember, everybody loves bacon.